where Lunch Money all began.
Yeah, it is a bit, and we're hopefully live. Maybe a few people can give us a thumbs up if they can hear us and see us. Everyone from their homes, I'm sure. Good numbers today, Alice.
Yeah, heaps of people joining us, which is awesome.
Thanks, Josh. We've got one yes there and a thumbs up from Tim. That's great. Well, welcome to another week of Lunch Money. It's brought to you by Sharesies, and at Sharesies, our purpose is to create the most financially empowered generation.
So for those of you who are new to Lunch Money, we do these every Thursday at lunchtime. This is a place where you as investors can hear from people leading some of the companies available on the Sharesies platform, as well as from other investing and industry experts.
Lunch Money is also available as a podcast on Spotify, Apple Podcasts, and Google Podcasts. If you're listening to us on Apple Podcasts, we'd really appreciate it if you could take a moment to leave a rating and comment. My name is Leighton Roberts, and I'm one of the co-founders at Sharesies.
And I'm Alice Rountree. I'm a financial analyst here at Sharesies. So before we get into today's discussion, we do just have to give a small legal disclaimer. So investing involves risk. You aren't guaranteed to make money and you might lose the money you started with. Any information that we provide is general only and current at the time. And if you are looking for help with your investment choices, we recommend talking to a licensed financial advice provider. Finally, we won't be providing any personalised advice as part of this webinar.
Thanks, Alice. And also just a quick reminder that if you have any questions for us, you can submit them through the Ask a Question button down below. Don't leave the questions in the discussion area as they're likely to get missed.
And also, please be kind and respectful towards our speakers and your fellow viewers. Otherwise, we will have to take steps to remove you from the webinar, which none of us want to do.
Definitely do not want to do that. So today we are joined by Zoe Wallis, the Chief Economist at Deloitte New Zealand. Yesterday, the Reserve Bank of New Zealand released its latest monetary policy statement. You might hear that being talked about as the NPS, and this is where it made its latest decision on the official cash rate and gave its economic outlook for New Zealand. So Zoe's here to chat about yesterday's announcement. Welcome, Zoe, and thank you so much for joining us again at Sharesies.
Kia ora, everyone, and thanks for having me. It's great to be here.
Yeah, as Leighton says, thanks for joining us, Zoe. It's great to have you here, and a really, really important announcement yesterday that was made. But before we do get into the details of the Reserve Bank's announcement from yesterday, could you just give us a little bit of a refresh over like what the official cash rate or OCR is, how the Reserve Bank uses this as a tool to stimulate the economy and also how it affects interest rates?
Yeah, absolutely. So the official cash rate, or OCR as we kind of abbreviate it to, is really the Reserve Bank's main tool to kind of implement its monetary policy settings in New Zealand. Central banks around the world typically have a primary interest rate that they use. It's called the OCR in New Zealand. And what that means is that actually banks can come and borrow and lend money to the Reserve Bank at around that OCR rate. And so it kind of sets the whole interest rate for your New Zealand economy basically off that. So in cases where your economy is running too hot and there might be too much pressure building up or too much inflation, which we'll come back to, then the Reserve Bank can lift the OCR to help cool things down because it makes it more expensive to borrow to spend. And that sort of takes some of the heat out of the economy. On the other side, they can lower the OCR, which is what they've been doing for several years now, in response to various sort of financial crises that we've seen come through and the lack of inflation pressure in the economy. And that helps provide stimulus into the economy and means it's cheaper for businesses and people to borrow, to go and invest and spend.
Great, thanks. So, I mean, we didn't plan this, I assure you, but we've really nailed the timing with getting you on to chat today because we actually started Lunch Money just over a year ago in the first lockdown level 4, and at the time, interest rates were very topical as well. So maybe you could just fill us in on what actually happened in yesterday's announcement. We know that it took some people as a surprise, although there was enough information out there probably to expect a surprise, and what you think the Reserve Bank's rationale was for the decision that they made.
Yeah, so it was a pretty interesting one going in. I mean, looking at the economic data in New Zealand, it has been really strong. So we've had, since, we've sort of come out of lockdown as a nation last year, we've actually seen consumer spending, business investment, business spend, business opportunities all rebound really strongly. Economic growth came back really well. We had a 1.6 quarterly growth rate in the March quarter, which was actually a really strong number. We've also had unemployment fall down to 4%, which is where it was pre-pandemic, and actually at what the Reserve Bank estimates is your kind of maximum sustainable level of employment in your economy. So pretty much everyone who wants a job within reason is largely sort of able to find something to do. There are obviously sectors that are exemptions to that, which, for example, tourism or perhaps international education, which is still suffering with border closures. But what the data was telling us is that the economy was in a really strong position going into the Reserve Bank's policy statement yesterday. And in response to that, most economists, including ourselves, were expecting the Reserve Bank to lift the OCR by 25 basis points, which would have been the first rate hike we've seen in 7 years. So going back up, finally getting off sort of emergency policy settings, which is really where we are at a cash rate of almost zero. So that was all fine, all good. They had all their forecasts prepped. They had their policy statement largely written. And then, of course, we had the COVID case come out and we had lockdown announced on Tuesday night. And that meant they had probably 24 hours, if that, to turn everything around and think, well, actually, what does this mean? Should we be in an environment where we're in full country lockdown lifting the OCR? Probably not. And that's the decision that they made, is to err on the side of caution, wait and see how significant this latest outbreak is, what impact that will have on the economy over the medium term, and just wait and assess things and take a little bit longer and think about where interest rates should head to support the economy. At the moment, I think from the press conference yesterday and the statement, the clear messaging is that interest rates are still going to move higher in New Zealand over the next year. But that is dependent on this latest lockdown not causing a significant dent or derailing the economic recovery that we've seen over the last year.
Yeah, interesting. It's great. Zoe and I worked together at KiwiBank for quite a few years, and it doesn't feel like that long ago, but in terms of interest rates, it would have been crazy to think that we were looking at the back of a quarter that we'd just seen that much growth, and we were going to say we're looking at increasing the OCR to 0.5%. It feels mad. Do you think that it was basically a done deal until this new news that the interest rates were going up, and did they speak to that explicitly?
Yeah, look, absolutely. I think all the commentary and the forecasts were clearly pointing towards a rate hike. If you look at their OCR forecasts as well, or what they left in their updated projections, they're still talking about a hike before the end of the year at the moment, and getting back towards an OCR of 2% sort of in 2023. So we are still talking about interest rates moving higher from here. It's just a matter of timing. But that said, as I mentioned before, there are a lot of unknown unknowns about what could happen with the COVID pandemic and the latest lockdown, particularly being the Delta variant and more contagious than last time round. So it's a little bit of a wait and see, but that's the central view at the moment.
Yeah, cool. And so you sort of, in what you were talking through there, you were giving the reasons behind, or more economic reasons, I suppose, on why we thought we were going to be going into this interest rate increase. And can you tell us a little bit about what parts, we know that tourism's not driving it. We know that some of the major pillars that have driven our economy for a long time. I'm not sure the last time we received 1.6 increase in a quarter was. I imagine it was a very long time ago. But can you just tell us what sort of made that number up and why it's really interesting and important for us to consider that when we're looking at the interest rates and how that plays back into other things in our lives?
Yeah, cool. And I think, it's not just that quarter growth as well. It's, the outlook for growth going forward as well is still pretty robust. There's several key things driving that. So particularly some areas of the economy. So construction, we've seen a record number of building consents come through, which means there's a huge amount of activity in construction sector, but we've also got a huge government pipeline of investment as well around infrastructure projects, which is meaning that the construction sector is really running hot at the moment and actually struggling to get the labour and materials that they need to try and complete the pipeline of projects that they've got underway, which may end up actually being an issue for delivering on the building consents, but we can maybe talk about housing market a little later. So that's sort of one of the key backbones, but the other is actually also consumer spending. So since lockdown, people have actually felt a lot more, had a higher propensity to go out and spend. They maybe had, 3 to 4 months of not spending particularly huge amounts, saving, just doing weekly supermarket shops, etc. As you've seen people much more, hospitality's really roared back into life, particularly in those areas, driven by domestic demand rather than international tourism. And you've seen people go out and buy big ticket items like new car sales are through the roof, durable spending, DIY, because everyone's obviously spent more time at home and is now maybe working more from home on a regular basis. And that also is being fueled by a positive spillover from the fact that house prices or our housing market has been so buoyant. So in New Zealanders typically, although I'm glad to see Sharesies is changing this, have their store of wealth invested in housing. And therefore, if your house price goes up, you get a bit of a wealth effect as you feel like you've kind of made money, even though you might not even realize that in cash, but you feel more confident going out and spending money. So those are sort of two areas of the economy that are seeing quite strong demand, but actually it's really broad-based, which is the other factor that's kind of a positive behind the growth numbers that we're seeing and the outlook that we're seeing, is that a lot of sectors are really experiencing quite strong demand from customers and the economy as a whole at the moment. So
yeah, I saw a really interesting, I think it was a meme or something came around on Instagram the other day, but it was definitely shows my age here a little bit, what I get targeted for with Insta, I think, but it was a building company and showed the price of materials, what you could buy in 2020 and what $1,000 could buy you and what $1,000 could buy you today. And it was like this pallet full of, it looked like you could build your office at home with it. And then now it was like 4 planks or 2x4 type thing. But like it's quite a cool visual representation of that change. I mean, you just touched on house prices. Anything out of the announcement yesterday, and what's the sort of Reserve Bank thinking there? Because that's a problem that seems to be only getting bigger.
Yeah, I mean, that's been a particularly interesting one to watch over the last year, right? If you'd sort of asked anyone at this point going into lockdown last year about what they thought would happen to house prices, myself included, would have been expecting the market to cool off, What we've seen actually is that huge amount of government support that came through in terms of stimulus around the wage subsidy, which meant people stayed employed for much longer than they could have done otherwise, and actually meant that businesses were able to keep people employed. Meant that unemployment never really rose above 6%, which was remarkable given some people were talking about 10 to 20%. So the fact that we've had solid employment, solid wage growth actually coming off the back of that as well, combined with record low interest rates and the removal of LVR restrictions, really facilitated a really strong rebound or strong continuation of price gains in the economy in New Zealand for the housing market. Big question as to where that goes from here, of course. And look, I don't have a crystal ball, but our view is that the current pace of house price appreciation can't be sustained. You can't go up by 20 to 30% year on year, year after year. You hit affordability constraints at some point, and you can see that happening in certain areas now. People are just getting locked out of the market. The reinstatement of LVR restrictions has also played a part. So what you saw quite a bit of during the year when LVRs were removed was investors really leveraging up on their equity gains in their existing property with a very low LVR requirement, meaning they could go and use that equity to buy a new house, buy another house. And so the investor segment came roaring back in the market once the sort of confidence got restored. And that's obviously having implications for first home buyers as well in terms of locking them out. There is a bit of rebalancing happening between the buyer mix now, and you're seeing more first home buyers starting to come back in with the LVR restrictions in place. But we also do expect to see house price appreciation moderate towards below 10% next year. Yeah.
Cool, thanks, Zoe. So just jumping back to yesterday's announcement, I mean, you mentioned before that no one has a crystal ball, and you also mentioned before that, a lot of the banks were forecasting an OCR increase. How did the share market react to yesterday's news? And, was that what you would have expected for that type of situation?
Yeah, it was an interesting one because obviously you had so much news in sort of a 48-hour cycle. So everyone was fully anticipating the Reserve Bank would hike. Typically, when you're in a rising interest rate environment, you see share market gains start to slow or even sometimes fall. But the kind of quasi-hawkish but hold statement from the Reserve Bank generated an interesting reaction across financial markets. For example, the Kiwi dollar fell quite sharply on the hold decision, but then actually recovered once people digested the news and realized actually we are still moving towards a hiking cycle. Similar thing for interest rates. So interest rates had been largely moving higher in anticipation of an OCR hike. When that wasn't delivered, things started to pare back, but actually everyone's like, well, it's probably a couple of months delay rather than we're actually going back into an on-hold cycle or a even cutting interest rate cycle or further monetary policy stimulus. So I guess the market reaction probably makes sense given where we've ended up. I think, we are still going to be looking at interest rates moving higher over time, but there's no panic to move now or to move that quickly over the hiking cycle, I think.
So I was just wondering, Zoe, if you could just refresh your the, what do you call it, tab for the thing, just so we can get the clear picture back, if that's all good. No, that's all right. If you just try refresh, we'll see. Quick delay, team, while we get Zoe back and humming. Maybe this wasn't a good idea. Oh, here we go.
Oh, here we go.
Hey, Zoe, you're back.
Awesome.
That's great.
Cool.
Can you hear us?
Yep, all good.
Yeah, cool. Don't worry, we managed to edit this stuff out before it goes into the podcast and stuff, and everyone listening well and truly expects this type of thing now, that's for sure. Back into the OCR conversation, what we were talking about, it's been held flat now. The Reserve Bank have given the indication that we're going into further reducing economic stimulus, and one way of doing that, and they do have options on the table now that they've introduced these other tools, but one way is the increase of interest rates. I think the question for a lot of people is, well, how's this going to impact me? So how do you think what's this going to flow through going to be into everyday New Zealanders?
Yeah, absolutely. So I guess one thing we've already seen and sort of touched on briefly is, rising interest rates. And when we say interest rates, the OCR feeds into what we call wholesale or market interest rates, which is basically what all your mortgage rates are set off, all your business borrowing rates are set off. And that has an impact, obviously, on prices and what people are paying, for example, on their mortgage, but also has an impact on where investments head, as we sort of touched on before. So thinking about the stock market, perhaps in a rising interest rate environment, you don't see as strong appreciation for growth companies. You see dividend companies still looking at yields and in comparison to what you might be able to get on other investments. So I think from a sort of everyday New Zealander point of view, there's two elements to it. So the first thing is, at the moment, people are seeing prices at the till go up because inflation is higher in the New Zealand economy. And actually, that's what the Reserve Bank's trying to manage. That's one of the two key mandates by putting interest rates up. So inflation in the New Zealand economy, and just to touch on inflation we talk about is they measure it as a basket of your typically purchased goods. So it might be your cell phone bill, the price of milk, the rent you pay. House prices aren't explicitly included in there, but construction costs are. Your rates, the cost of a haircut, for example, a basket of goods that you might see a normal New Zealander buy within a month or within a year. And you look at how the price of those changes. So at the moment, that basket of goods is going up by about 3.3% every year, which is actually quite high in New Zealand. So we typically haven't seen an inflation rate above 2% for quite some time, but the Reserve Bank tries to keep inflation at around 2%. So that rapidly rising cost of goods, and particularly when it's rising by more than people's wages, which it is at the moment, so wage growth's going up just over 2% year on year at the moment, has an impact on everyday New Zealanders. So that's probably the first point, is that the Reserve Bank is actually trying to manage that and ensure that that doesn't get away on people. So affordability of everyday living and goods is within a reasonable, is going up at a slow pace that's manageable and hopefully largely in line with wage growth. So that's probably the first impact that people have been seeing is, menu prices have been going up. I think it's $12 a kilo for tomatoes at the moment. Crazy sort of food prices are kind of coming through. And those are supply chain issues as well, in terms of actually getting goods into the country, or a bunch of different drivers that might result in different price appreciation for goods. But Reserve Bank's really trying to keep a lid on that. So what they're doing to control that is lifting the OCR. And so that also has a flow-on effect for obviously people thinking about whether they borrow to go and spend up. Because if you're borrowing, obviously the cost of that borrowing and repaying that money is now increased with higher interest rates. But it also means that people who might have an existing mortgage, for example, are now going to be paying more on their mortgage because mortgage rates have been creeping higher. And you would have seen that even before the OCR decision yesterday, is that interest rates have been creeping higher in anticipation of the Reserve Bank lifting the OCR. So it's already actually starting to have an impact, and mortgage rates have moved off the lows they were a few months ago. So all of those things have an impact on sort of everyday New Zealanders, and it just depends, I guess, on which situation you're in, whether you're a borrower or a saver. If you're a saver, actually, and you've probably been underappreciated in terms of interest rate hikes for the last few years, we've positively seen term deposit rates starting to move higher now. But we don't expect them to get back to any of the sort of pre-GFC levels we were talking about. The Reserve Bank's forecast for the OCR is at about getting to about 2% by 2024, 2023. So it's not a rapid move higher in terms of interest rates, but at least it's better than it has been.
Yeah, I guess like chatting about how interest rates rising could impact on everyday New Zealanders, how does that then flow through to some of those key financial markets like, the share markets or bond markets and that?
Yes, absolutely. I mean, as I sort of was saying, you've seen so bond yields have been moving higher for quite some time. In New Zealand, for example, our bond yields are really driven by partly what's going on locally, particularly for your short-term interest rates. So anything out to sort of 2 to 3 years tends to be more driven by New Zealand monetary policy. But actually, if you look at bond yields out sort of 5 to 10 years, there's a really strong correlation with what's going on internationally. And up until recently, everyone was talking about the reflation trade. So this was global inflation coming back, because what we're talking about in terms of higher inflation rates in New Zealand is being seen across the world as well. So in the US, I think their inflation rate's got above 4% recently. So you can see that price pressure, and it's a combination of factors. So supply and capacity constraints and supply chain issues globally with shipping disruptions due to COVID have had a huge impact. It just means that everyone's competing for the same goods. The price of those naturally goes up if you can't get them. In New Zealand, there's examples of people waiting 6 months for curtains, or 3 months for a washing machine, because you actually just can't get goods into the country. So the price of whatever is available often starts to creep higher. But that's, as I said, that's been happening globally. So you've seen international bond yields move higher in response to that, bond prices fall. That's maybe come off a little bit in the last month or so, just largely with the outbreaks of the Delta variant has caused a bit more caution in financial markets. And you can see that probably coming through in the equity market as well, although I think with interest rates set to remain low, you've still got this underlying driver of a low yield and interest rate market. Plus, not to mention, people who do have money to invest still looking for a return, and there's probably no point in leaving it in a term deposit at the bank at the moment, because you're earning less in your term deposit return than you would be eating away every year by inflation. So your actual, what we call a real return, so the difference between your interest rate you might get on a term deposit and the rate of inflation is negative. So you're actually going backwards in terms of the value of what that money will buy you in the future. Yeah.
Yeah,
a great time to be studying economics. Sorry, Alice.
No, that's okay. You go, Leighton.
No, I had nothing to say except for that, really. I just think there's so many interesting points going on here, and I think it's quite fascinating to watch. Do you have another question, Alice? Otherwise, I will.
Yeah. Oh, I was just going to say, much along the same lines, like there's so many moving parts as you talk about, Zoe, inflation, interest rates, supply chain challenges. I guess, how do you see this impacting the overall New Zealand economy?
This being, those pieces, or the latest lockdown, or both.
I guess,
yeah.
all of them kind of together. This, as I mentioned, there's so many moving parts, and they're impacting on New Zealanders and the economy in many different ways. I guess, do you have a view on how together they might impact the economy?
Yeah, I mean, I think if you go back a year ago, we were kind of expecting supply chain disruption to have been resolved, but economic growth to be much weaker than it is. And what we've ended up with is the opposite situation. So you've actually got really strong growth, but supply chain issues, which are actually causing really strong inflation as well. So from that point of view, you think about and going back to the Reserve Bank yesterday, they were in their May monetary policy statement, talking about not hiking interest rates till September next year, so a full year away. so much has shifted in the last 3 months in terms of the economic data we're seeing and the strength of the economy and the recovery that's coming through, that they shifted forward almost a whole year. Well, they did shift forward a whole year until the lockdown was announced, pretty much. So in terms of, how this plays out going forward, I think supply chain issues have been much more drawn out than we would have initially anticipated, and they're still working through those pieces. I think, there's some fundamental things like lack of supply of timber in New Zealand, for example, at the moment, that's causing things like construction costs to go through the roof. Until we see borders reopen, we are really constrained in terms of our labour market and how many people we can take, we can get into the country to help support some of these projects, for example. So we can't import labour, and actually New Zealand's been really reliant on that for quite a few years. So we had population growth going up 2% year on year prior to COVID. I think net migration the year prior was 90,000. So huge number of people coming into the country. That's almost gone to zero. It's less than 5,000 now. So when you think about that, it actually is putting a natural cap on how far your economy can grow, because you can't get the resources to deliver on projects that you want to do, or to deliver on, like businesses can't get goods into the country to sell. So that limits your actual profitability as well. So we are really in this weird environment at the moment where you're really supply constrained, but actually everyone wants to go out and buy goods and buy services. And so the demand side's really buoyant. I think how that will eventually remedy itself, and particularly as you see interest rates go up, you'll see demand start to cool off a little bit as interest rates move higher, and people perhaps feel, mortgage repayments go up, people feel a little bit more constrained in terms of their spending. But then once borders reopen, you'll start to see some of those supply side issues ease back as well. But it's probably still, given where we are now with the Delta variant outbreaks, at least 6 to 12 months away.
Yeah, really interesting. And I think, that the housing market just, in my mind, still adds just another level of confusion on all of this. I mean, imagine if it was included in some of those growth and inflation numbers, and what that would do to us. But it is interesting, isn't it? We've sort of blamed or talked to the supply and demand issue so much, and now we seem to have, you say we're at record levels of consent, which I acknowledge isn't a house yet, but there is a lot of building going on, and then at the same time the inflation number is so much lower coming into the country, yet our house prices still appreciating sort of 30% year on year. So interesting. Is there anything else from yesterday, Zoe, that you think people listening today would be interested in, specifically with regards to people thinking about their investments at the moment?
Yeah, I mean, I think one of probably the other key thing is just around, consumer spending, and thinking about the types of companies that are going to perform well over the next year or two, and where you're seeing, strong opportunities for growth. So obviously we still have a pandemic, we still have a lot of health issues, healthcare companies. We've still got, long-term, we've still got an aging population, and actually that gets exacerbated with less net migration, because our domestic population is actually naturally older, and your immigrant population is naturally sort of concentrated in those between about 15 to 35 years old. So with fewer immigrants, our aging population issue gets accelerated. I think, if you're looking at pandemic and lockdown again, online companies benefit hugely from that situation. So anyone with a strong online presence, or a strong online, as we've seen tech companies before, outperform over the last year, unsurprisingly, in that regard. So, I mean, I think it's, it's probably less what was in the RBNZ statement, but thinking about the broader context of what's going on in the economy. Construction companies, obviously, as I say, experiencing huge amounts of demand. But you've also seen things like manufacturing actually rebound relatively strongly. If you're thinking about longer term trends, one of the big question marks or things to think through is whether or not you see more onshoring in the wake of COVID. So, with such obvious supply chain issues coming through over the last year, people are now wondering, is the sort of big international trade and relying on everyone specializing on what they're best at producing the best model? Do we need to onshore more in terms of our production of goods and services, and goods in particular? I mean, New Zealand's pretty lucky from that point of view, is that we're a large food producer, so we didn't have to worry about that through pandemic, but several other countries did. So I think those are probably the big themes that you want to think through when you're looking at your investment portfolio, and obviously taking a long-term view is a good idea. this isn't investment advice. All of Alice's caveats also
No,
apply.
but
Yeah,
we are
but
big
something to
fans of
think
dollar cost
through.
averaging and long-term investing at Sharesies, that's for sure. I mean, the last two, I think, the markets were down at the end of the day on Tuesday, and then bounced up again yesterday. I think on what was 70. Last time I looked at the markets yesterday, there's about 75 companies that were up for the day and about 50 that were down, which is, given the news, not necessarily what you might think, but it's funny times. Hey, Alice, maybe leave you to ask some questions from people listening.
Yeah, sure thing. Thanks, Leighton. So, we've got a few questions that have been asked by people listening in today. So the first one is, Zoe, what is your opinion as to the effectiveness of the OCR as a tool to tame house prices? And in a general way, has the OCR become outdated as a control tool by central banks?
Cool. Okay, good questions. I'll answer those obviously in two parts. There's kind of two issues there. So the first is the OCR an effective tool to control house prices? Look, it absolutely has an impact on the housing market in terms of the feed through from the OCR to wholesale interest rates and then to mortgage rates. Mortgage rates are higher, then that has an impact on how affordable housing is and how much house prices are likely to appreciate. Should it be a tool to control the housing market is probably another question I would add in there. So the Reserve Bank's mandate, and it has been changing over the last few years based on discussions with the government, was primarily not a housing market question. It was very much a controlling the level of inflation, or CPI, and more recently added in the second mandate of looking at trying to create maximum or sustainable full employment in the New Zealand economy. Now, obviously, you can't fully separate out the effects of interest rates from the housing market or the impact from the housing market on inflation, for example. But fundamentally, the Reserve Bank isn't trying to control the housing market. I think if you look at the housing market in New Zealand, there are a range of factors that need addressing. And this is just my personal opinion, is that, we've had really strong population growth. We haven't seen supply matching that strong population growth in terms of providing housing up until recently. As Leighton alluded to, now you've got almost no population growth and actually really strong supply side coming through in terms of building consents. So hopefully we get a bit of rebalancing there, but there is definitely a bit of a mismatch, or has historically been quite a strong mismatch between supply and demand, and I believe that's true, and it varies by region, of course, as well, which also partly drives some of the regional price appreciation differences that you've been seeing. The other piece is that there's a New Zealand psyche long term about investing in housing. It's the thing that our parents made money off. It's the thing that generations before made money off. It's our store of wealth, and changing that is quite multidimensional and quite tricky. There's also, thinking about our rental market and why people aren't happier to rent long term, or what the system needs to make it better and more attractive for people to do that. And I think we're moving in a positive direction with things like healthy homes and changing tenancy law, but it's not at the standard that you see in other places like Europe, for example, where there's a lower rate of home ownership and people are very comfortable renting for their lives. Which also means that people free up their savings to invest in other different assets, which might actually be more productive from an economic point of view for your economy. So New Zealand has a relatively small share market base, possibly as a side effect of the fact that people people largely invest in housing still, and the share market as an investment. People were a bit scarred by the 1987 crash, but B, also people just don't think of it as a wholesale store of all your wealth. So those two factors combined probably have quite a big impact in terms of how we think about housing in New Zealand. So while I acknowledge that interest rates have a part to play in how much you start to see house prices appreciate, I don't think that's the entire issue, and I don't think that the Reserve Bank necessarily should be adding that as a wholesale mandate to the two things that they're trying to do. Once you get more than two policy mandates for the central bank, it actually becomes quite tricky to try and balance things. And they haven't run into that issue yet since they've had unemployment added to their mandate. But they used to just have to control inflation, and that was it. Very easy when you've got one policy target, one mandate. Yeah, that's a bit of a long-winded answer. But and the second part was, remind me.
So it was just, in a general way, has the OCR become an outdated tool as a control tool by central banks?
Yeah, interesting question. And I guess, in terms of where we've got to over the last few years post GFC as well, it's been added to. Interest rates haven't been the only tool people have used. We've gone down the quantitative easing path, many countries globally and in New Zealand as well. I don't think someone once said it's like pushing on a string. That's one analogy for it, is that sometimes it doesn't work. Sometimes there's a lagged effect. And what the Reserve Bank's trying to do is actually get target inflation 2 years ahead, really, of where we are currently. So you're always operating based on, best estimates and best forecasts. So I think at the moment that, in combination with, other policy levers that we've got, and you've seen, macroprudential tools come into play quite significantly. So things like loan to value ratio restrictions, from a financial stability point of view, but from a monetary policy point of view, I still think it's probably the best tool we have, but it's not fully effective all the time. Yeah.
Cool, thanks, Zoe. Now, this question here, just factoring in that we don't give personalised advice, but it asks, what factors would you recommend taking into consideration for those with a fixed interest rate mortgage maturing in the next couple of months, therefore needing to make a decision on interest rates and how long to fix for? So maybe, what are some things that they could consider, or what do they need to think
Am I allowed
about?
to answer that?
Just
Yes,
in a general sense.
in a general sense, I mean, I think so. First of all, you have already seen mortgage rates move up quite a bit in response to the anticipation of OCR hikes, and I don't think anyone's put their mortgage rates down since yesterday yet. I don't think that will happen, probably. They tend to be sticky downwards. Yeah, so look, I think, a lot of what happens is interest rate hikes or expectations get built into the market already. So, if you're going to try and preempt and fix in advance of that, you really have to be quite a way in advance of when everyone else starts to think that interest rates are going to move higher. The other thing, obviously, to take into account would be the break fees associated with it if you were looking to break and refix. I mean, something, and it goes to Leighton's point about diversification, is that, think about, actually, do you want to put all your eggs in one basket and put all your mortgage refix back on a 1 year or a 2 year term? Or do you want to kind of hedge your bets a little bit more and think more broadly about a portfolio, which might mean, actually, if interest rates go up for a year, but they go down in 3 years' time, you might actually, on average, end up better off. And I think, no one has perfect information or perfect forecasts. So diversification can mitigate some of your risks in that regard.
Good point. Thanks, Zoe. Now, this one, I mean, you just mentioned, no one has perfect forecasts, but how far can you predict what economic markets would look like, considering how unstable it is because of COVID-19? What would be the best strategy for short term, saying 6 months, etc.? So maybe that second part is just asking, how best would you look at the economy for the short while?
Yeah, great question. And I think, the Reserve Bank itself sort of admitted this yesterday. Their forecasts were based on the information they had up until, I think they finalised most of their forecasts on the 11th of August. So, things were looking pretty solid at that point. But with lockdown, as happened last year again, there's so many unknowns. So waiting to see actually how many cases come up. And I think we're going to probably see, I'm not a health expert, but it certainly feels like we're going the way of there are going to be a lot more cases than we're currently seeing the numbers for yet. I think there's a significant risk that lockdown's a lot more prolonged than 3 and 7 days. And we head back towards something more like what we saw in the previous lockdown, where, the whole country was in lockdown for a month, lockdown level 3 for 2 to 3 weeks after that, and then slow staggering out, possibly depending on which region you're in. So if you're talking about sort of a 2-month shutdown of your economy, that does have a major impact on, obviously, your GDP, your spending, your sort of productivity as a whole. And with the Delta variant, I think, there's a lot more caution around people being quite careful around spread as well this time, which might cause it to be even longer. So obviously I would probably take into account or factor in thinking about there's a risk this goes for at least 2 months in terms of serious lockdown, and what that impact would be on the economy, particularly, things like hospitality businesses. But again, we have things like the wage subsidy coming back in, which means that hopefully once things do return to normal, what we see is a similar bounce back to actually what we saw post last year's lockdowns, which was actually things things rebounded quite strongly, and because people can't travel overseas, they have a more propensity to perhaps go out and eat and spend up local hospitality places, or buy durable goods, which we saw again. People buying a new car rather than going on an overseas trip. Those sort of themes come back through. So that's my expectation at the moment. But as you say, there's a huge amount of uncertainty as you head down into lockdown. We have a bit of a model now. We have probably more information than we had last time round, when we just weren't sure. And, there was talk of like 1930 style depression, which is just not what we've seen. So a bit different. Yeah.
Cool. And then this next question, it's sort of along the same line, but given the current COVID-19 level 4 response, what does the short-term investment outlook look like? So, kind of flowing on from the economy chat that we just talked about.
Yeah, and obviously investment captures quite a broad range of things in there. But I think one of the interesting things is probably just around fear, and actually it's almost the psychological reaction to what's happening. Can be more so, or more a driving force than the actual fundamentals sometimes. So that was what you saw happen in the first, pandemic outbreak, was absolute fear. 1930 style depression is going to happen, sell everything, panic. I think you saw that quickly turn around though, as people started to get it under control. And you do have to remember now we've got a vaccine as well, which is getting rolled out. And hopefully that pace of that might even get accelerated over the next couple of weeks. And so in terms of thinking about investments, it's probably two factors. So what are the fundamental companies that are going to suffer as a result of lockdown? Should be relatively easy to work those out. People who can't operate for the next 8 weeks will have a dent, but then your view on how strongly they will come back following lockdown, particularly as your immunization rates get up. The other bit is then just thinking through from a fear point of view. What we haven't seen is a short-term sell-off on the market. There hasn't been a massive panic to date. Whether or not we actually see that come through remains to be seen, but it feels like actually people, the sentiment and psychological sentiment is, we've been here before, we've done this, we've got it under control, look what happened to the share market last time. Actually, I might just sit tight. Yeah.
No, very good tidbits of insight there, Zoe. I've just got one last question. It's actually from one of our colleagues here at Sharesies, who's interested to know what is it like to be an economist, or what do you actually do in your day-to-day role?
Oh, cool. Great question. I haven't been asked that for a while. So I'm what they call a macroeconomist. So I largely look at sort of big picture New Zealand or big picture country economy down to sort of an industry level. There's obviously also microeconomists who deal with the economics of individual firms. But I love the sort of big picture, high level overview side of things. What do I do? A bit of reading. Trying to keep up with, obviously Stats is always releasing new pieces of data which give us better information about the economy. We also follow things like, the ANZ Business Outlook, quarterly surveys of business opinion, which give us a guide on how businesses and consumers are feeling about things. We watch commodity prices, we watch financial markets a bit. We pay a lot of attention to the Reserve Bank's decisions and spend a bit of time doing our own forecasts. So we run our own macroeconomic model, which forecasts where we think things in New Zealand are going to head. And we're actually developing that out to get down to quite a granular level around where we think individual industries in New Zealand are going as well. So that's one of my key pieces of work at the moment, is looking at sort of the industry level and thinking about where the opportunities are in New Zealand, what the outlook is, how that ties back into the bigger picture for our economy. Hopefully that's answered that.
Awesome.
Happy to have a
Thanks,
chat.
Zoe.
Yeah.
Cool. And I'm just conscious of time because no doubt a lot of people will be wanting to tune into the 1 p.m. Announcement. But so thank you everyone for tuning in today. And big thank you to Zoe for joining us. We really appreciate your time and your expertise on everything we've talked about today.
Great to chat.
Thanks. Absolutely. Second that. Thanks, Zoe. Great to see you again, and hopefully we'll get to catch up soon once we get out of this this latest lockdown, which we will get a bit more information on in the next couple of minutes. To everyone listening, please check out our new daily financial news podcast, Recap. It's around 10 minutes long and published at 5 p.m. Monday to Friday on Spotify, Apple Podcasts, and Google Podcasts. And you'll get to hear Alice, Jose, and special guests share what's going on in the news.
Yeah, thanks, Leighton. And if to people listening out there, if you do like planning well in advance, then we'll give you a heads up that on the 2nd of September, so that's in 2 weeks' time, we'll be joined by Ross Taylor, who is the CEO of Fletcher Building Limited, on Lunch Money. And very timely, because Fletcher Building actually just released their financial results for their year yesterday. So he'll be in to chat about those results and what's been happening for the company. And also we'll have the opportunity to answer questions that you ask him. So you can register through the link in the chat.
Great, thanks, Alice. In the meantime, we'll see you back here next Thursday for another round of Lunch Money. Keep an eye out on our social channels for news on who our guest will be. Enjoy the rest of your week and stay safe. And thanks so much again, Zoe.
Thanks, everyone. Bye.